Hi everyone, today we are going to discuss the RMI indicator and how to use it for quick, fast buy and sell signals. How do you really apply it in real time? Because it requires a little bit of understanding of the basics of momentum indicators, and I'll take you through that because it's one of the very important tools I think available on what is now the Strike platform that India Charts has launched. When you come to the Strike platform, once you open this page for any particular stock, you find a section which says charts, and then within interactive charts, you can actually choose what is the Rohit setup. And when you do that, you actually see the RMI indicator going through multiple buy and sell signals and all the levels of averages, the upper band, lower band, and this is the entire setup that you actually see on the price. But what you want to really understand is how do we use this indicator which is at the bottom, because this indicator also shows up under what we call as the scanner. So when you go to the scanner section, you find the Rohit scanner, and what we try to do here is that we try to search for stocks that are generating those buy and sell signals, right? When the indicator is crossing over, giving a buy signal; when it is crossing over, giving a sell signal. So we'll go step by step understanding what those crossover signals are and how I have thought about it, so that you can put this tool to use to find the ideas that you want, right? That's the end objective that you should all have. So let's get back to the basic idea of how do we use it and what is this all about. So when it comes to momentum indicators, there have always been two types: those which are range bound that move between 0 and 100, and those which are non-range bound and move anywhere around, mostly around a zero line. RMI, or the Rohit Momentum Indicator, is a non-range bound indicator, and I actually like non-range bound indicators because range bound indicators will get to the point of say 100 or reach the point closer to 0, and then they're considered overbought or oversold. But sometimes in a trending market, prices can continue to rise, and that is where sometimes non-range bound indicators can extend longer and not give you an early indication of a reversal. Now, of course, we will deal with all of that and look at also what are the slight variations of the RMI indicator which will come up on Strike at a later point. But let's get an understanding of the basic tool. What is the zero line? What are positive and negative divergences that tend to develop on momentum indicators and on the RMI, and how do we use that? Then confirming along with additional tools, multi-time frame analysis, and using the scanner itself. So this is the entire process what we'll go through in this presentation, so that you can get a full insight of how you can use this to your best, right? So when I think of any momentum indicator, and specifically the RMI, I always wanted something which is smooth, which is fast, faster than MACD, because that's always been criticized for being a little slow, very smooth, but slower than other indicators. Whereas if you try to go with a faster, pure ROC, it is very noisy, or some indicators give a lot of buy sell signals, or a stochastic moves very fast from buy to sell. So you needed something that's smooth and looks like a sine wave. Now, why a sine wave? Because we like the idea that something will move up and down, as it does over here. Helps you identify complete cycles in the market, right? When prices are moving back and forth, even if they are making higher highs and higher lows, they are having momentum cycles where it's trending, then it slows down, then it falls a bit, and then it starts trending again. And so each of these cycles should be captured, and the process of capturing these cycles means understanding this sine wave around a midline, and that midline is what we call the zero line, which is where this horizontal line comes up. So a sine wave moves up and down this zero line. It's only when a complete cycle is complete that we can, when it's complete, which means that it starts from the low point, goes up above the zero line, and comes all the way back down, that we can actually conclude that yes, we have done something over here. And that's essentially how we would think about this indicator as well. When we look at it on this chart, you'll find the indicator running through a zero line, which is the dotted line over here, and it goes up, it comes all the way down, and I call that a complete cycle. When it goes up and comes back down, that's your completed cycle. So it does this again and again and again in different sizes. Each move is different in size and scale, but it definitely helps clearing our head. So if we actually move to a Nifty 50 and we are looking at RMI indicator over there, then even within the index we can get certain smooth cycles on any time frame. So whether it's the daily chart or I move to the weekly chart, okay, I can actually get cycles which are on any time frame involved, where it moves up, comes back below zero, and then starts a fresh cycle, comes back, and then starts another cycle. Now, the reason to think about this in cycles is one of my core beliefs is that the cycle is the trend, and you want to ride as much of the trend as possible. You want to, be able to make most of the gains that come with riding a trend, and that is what the indicator should help you to do. So it's not essentially buy today, sell tomorrow. That is a completely different art. Or if you're trading intraday, you might want to run this on an hourly chart. We can introduce at a later point of time. But right now, if you want to look at it, even if we are doing a positional trade, so if I'm looking at the daily chart, and I want to ride this move, so if you look at this, the RMI gave a buy signal here sometime in late March. And since then, we see it whipsawing a bit, but it's not come back to the zero line, right? It's not pulled all the way back. And that sort of keeps the price extending or the trend extending to the upside, and the cycle is not complete. So if it's not complete, which means the trend is not complete and it's extending. So that is sort of how we think about it. And in most cases, when you have an up down market, as you see over here, you'll actually find that the up and down moves are cleanly captured. So if you get a buy signal, moves up, it reverses, you get the signal, and then it goes all the way down, then goes all the way up, and then goes all the way. In a trending market, however, you will find that it tends to whipsaw a bit and develop divergences. And at that point of time, we use additional tools to really tell us, how we can ride this longer. We can use either trend lines or we can use moving averages, right? A mix of one of the two can actually help you ride the entire trend along with the RMI. So whenever the RMI gives a sell signal, is it meaning that, it's going to go back to zero? Not necessarily, because you might not have a trend reversal. So if you draw a trend line from the lows, or if you are using a moving average as is plotted already on this chart, you have the Bollinger Band with the 20-day moving average, for example. If prices are not going below these moving averages, then you actually don't have a trend reversal confirmation in combination with the RMI. So that sort of helps you staying the course with the trend at many points of time when there are slight whipsaws. Like for example, there's a whipsaw here, there's a whipsaw here, but you haven't come back to zero. So the cycle is incomplete. But are you getting a trend confirmation here from either a trend line break or from a trend reversal below the averages? So you can draw trend lines like this one. So this trend line held here, it appears to break at this point of time. So that can happen sometimes, and sometimes the moving average will hold, sometimes the trend line will hold. So that is where a little bit of technical judgment comes in. But once you do that, you can actually ride an entire move of the market in a particular direction, as long as that cycle is not complete. And that cycle only completes when we break everything along with the RMI coming back. So when it's coming back here to zero, it's actually completing a cycle, going through a pullback, and till you get the next buy signal, you don't get the next cycle, right? So then actually we end up waiting for the next buy signal. So if I get a sell signal here, okay, and I want to buy again, I have to wait for this buy signal. This is sort of how you also get patience. Patience is built in by waiting for the next signal. Why should I act? Say I want to be a buyer because I think, okay, this is a bull market. Okay, I missed the last opportunity to buy. Am I simply going to buy here because it's gone up for 6 days? The answer is probably not. You'd want to wait for the next signal. Either prices come back to the next trend line support. So if I actually want to draw a trend line support, I could draw it from this bottom to this bottom and extend it here. Or I could wait for the averages to kick in, and only when prices are closer to a support level, is where I want to actually see, okay, is the RMI really giving me a sell signal, buy signal from that point of time? If that level holds, then we are still extending on the way up, and we might get another buy signal. Like here, it does tend to give a sell and a buy again. That's a point at which we consider that the trend is in continuation. And so you get these mid-range entry points, and then there's the full cycle entry point. Now, the full cycle ones I think are more important if you are either a positional trader or an investor, right? You don't want to be getting in between a move when you don't know whether that move can go wrong, and how much more is left on the upside, which would require additional analysis using maybe Elliott wave theory to know what could be the extent of a Fibonacci extension on the upside. But if you don't have access to that and you're simply using the indicator, then the discipline is to wait for the next signal. I missed this buy signal, it's already gone halfway up, I wait for the next buy signal. Okay, and when the next buy signal comes, then I act upon it. But the next buy signal should only come after a completed cycle. So what that means is the green indicator, which is the RMI, must complete its cycle, which means it must come all the way back to zero, but in fact go below zero. And then after it's gone below zero, when it starts coming up and gives a buy signal, those are the more relevant buy signals. Okay, the rest could actually be false signals. And so the best signals on the buy side are those which come after the green line has gone below the zero line, and the best sell signals come after the green line has gone above the zero line and then is cutting back to the downside. Okay, now someone might ask me a very basic question: what is a buy and a sell signal? So taking you there, the green line is essentially the RMI, which is the momentum of the market. Okay, a smooth momentum indicator of the market, and we call it a buy or a sell signal when it crosses over the red line. Okay, the red average, which is basically a 9-day exponential moving average of the green indicator itself. Remember, the 9 EMA is a common one. It's used even in the MACD and most other indicators. So I automatically plot a 9 EMA on most indicators to get those swing reversals, because that's how it works. And in the case of an RMI, it essentially gives you buy and sell signals when you get the crossover. Okay, so when the green goes above the red over here, it's a buy signal. When the green goes below the red, it's a sell signal. And like I said, when I get this sell signal, is it signal to sell, or do I watch for an additional confirmation, either from a breaking a trend line or breaking of a moving average? Once I get those confirmations, then I can actually say that the trend has changed from up to down, and then that sell signal is relevant to persons who are looking at the short side, right? So are you looking for a bullish signal or bearish signal is also a question, but based on what we are looking for is how we would really respond. So for example, if I was looking for sell signals, I got one sell signal here, and say this market has already come down and now I don't want to act. I wait for the next sell signal, which means I have to wait for this entire momentum trigger to go up, and then for it to trigger a sell after breaking something, a trend reversal. And once that happens and the RMI gives a sell signal, is when I get the next sell indication. The same is true on the buy side. If I've missed this move, I really will need to wait for the next cycle. It's just my bad luck, I missed it. And that's how you get discipline, right? It's very easy to get carried away and buy a higher high because the market is running away. But you're going to need the discipline of being able to enter at the right time. And that simply is the focus that, well, if I missed one cycle, one sine wave, I wait for the next sine wave. But as I explained earlier, in a trending market like this, there may be entry points at somewhere in between if prices do pull back to that trend line or average as a support, and you would have to consider yourself whether you want to make an entry at that point midway, with that being the risk that support holds and that it actually extends higher, because when it does extend higher, we would consider as part of the existing cycle and not a completed cycle till it actually comes back below zero. So that can sometimes, in a trending market, can consume time. Here we already been in this scenario 3 to 4 months trending, and therefore you don't get a fresh cycle as such. And if you missed out, you missed out months of move, which is why it's very important to stay alert in the market, for signals that you want, and when that signal comes, to be able to take action that is relevant. But the discipline of waiting has always been helpful, because many times we get caught in the wrong trades because of the fear of missing out. And if you have a tool like this which forces discipline to you, then you might actually be helped in waiting for the right risk reward to kick in. And so this kind of analysis can go to another level when you start using multi-time frame charts, which means that I'm not just looking at daily, but I'm also looking at weekly, right? I'm looking at what is the weekly cycle and what is the daily cycle in conjunction to each other. So 2 time frames, you can choose any two. You can choose the daily hourly, daily weekly, weekly monthly. And when you take those combinations, like say for example, we are looking at the weekly chart here, we got a buy signal at this point of time, and it is just continuing higher, right? There's no whipsaw, there's no sell signal again, there's nothing to do at the weekly time frame. So what do you do on the daily time frame? Well, if the weekly time frame is bullish, on the daily time frame, every buy signal is an indication to add to your position or to make another entry, and so on. So essentially what the weekly time frame does, it gives you the bias that, okay, broadly now we are in an uptrend and we need to only use the buy signals on the lower time frame. And this is also classic to basic training in trading, that anybody would give you, that if the larger trend is up, what you really want to do is, trade the bullish side only, and if the larger trend is down, you want to trade the bearish side. But you do that by using a lower time frame, right? So on the higher time frame, you determine what's the larger trend, which you can see here is in buy. Since this new buy occurred over here on the 10th of April, every week it's been a buy, and that's the trend that is indicated here. So as long as the weekly is in buy, I switch to the daily, and every time I get a buy signal on the daily chart, you know, that's a point of second entry, third entry, fourth entry, and that is essentially how you end up thinking about this. Okay, that you use multi time frames, and you can therefore, if you're slightly longer position, I mean you're doing investing for a long period of time, you want to invest, then you use the monthly and weekly combination, where the monthly cycles, which are much longer in duration, broadly tell you which side of this bull run you want to be for the next year. And then you use every opportunity, maybe on the weekly time frame when you get a buy signal, to really stay invested in line with what the monthly is indicating. So essentially the lower time frame helps you fine tune your trade, and the higher time frame tells you what the trend is in and the direction in which you really want to take your trade. So it sets the course, and that is what we call as multi time frame analysis. Now once you got the hack of what multi time frame analysis is, then you're in a better situation to understanding what are the scanners. Okay, what the scanner here is essentially doing, okay, which is the Rohit scanner. Moment you click on it, it's actually telling you these signals across time frames. So it's saving you a lot of work, where you would have to actually go to the technical chart and switch between daily, weekly and monthly and look at each chart and see what the setup is. Here it is telling you the setup right in front, so you've actually scanned it. You can choose what basket you want, whether it's the mid cap stocks or the large cap stocks. Whatever basket you choose, we can actually start drilling down on that. So let's say we choose mid cap. So mid cap 100 stocks show up here, and the signals across time frames show up for those stocks. Now you want to further drill down. You feel, okay, the market's going up, I want to look only for buy signals, and I want new buy signals on the lower time frame. So I can use this filter over here, and I can choose show me only new buy signals. And so I have two new buy signals, and show me those new buy signals which are likely to get generated today. So therefore I keep the live mode on. So when I keep the live mode on, I have new RMI buy signals that are showing up here that will be confirmed on today's close, and I can click on this and it will show me the chart. So now I have a chart of Honda Auto. You can see that here prices did pull back to the 40-day average, but on a closing basis we didn't really go below the 20. So it's sort of an extension. This cycle didn't complete, it didn't come back to zero, and it's extending, giving a fresh buy signal here, as though price trends will actually continue for the particular stock. That's what it's indicating right now. It can of course change tomorrow, but this is the indication that you look for. And like I said, if you want the ideal new cycle, then you look for a stock which is starting with a trend reading below zero. So you look for that. Like here there was a trend reading which started below zero. It gave a buy signal, again went into sell. It's sort of in the same trading range. So is this buy signal also relevant? Then maybe it could be. Okay, so that's what this ends up telling you. But at times, when the trend is starting, you might find stocks that are coming from below the zero line, exactly as we discussed. And this is a very quick way of doing it and putting it for any basket. Now you may say, okay, well, what will come today will confirm only at 3:30, right, at the close, and that is the time to really think about taking these trades. But it's early morning right now, and I want to check out which are the signals that came yesterday, okay, on yesterday's closing. So for that we have a second option. It's called the last candle close. Moment I click on last candle close, it tells me where the RMI readings were for whatever basket I'll choose. Say let's choose the Nifty 50 as of yesterday's closing. So here when I'm looking at a new buy signal, this is a buy signal that has already happened yesterday, and you can actually see, well, today it's crossing back, so it's sort of failing to hold, and therefore it's a goner. And then you can search for another one. So we look at power grid. Here also on the daily chart, it was giving a buy signal. Now it's a goner. So you can find failures as well, where there was a signal and something didn't happen, by looking at the previous day. But you can also combine this with weekly, right? So on weekly charts, you want to see only the buy signals. You can combine it. So if you want to see new buy signals, now fortunately, because there are only two new buys, you find the weekly is already in buy. But it's possible you get a lot of stocks here where weekly is also in sell. Say for example, if it was the Nifty 500. Okay, so we have a lot of new buys over here. But you might say you don't want those which are in sell mode. I only want those on weekly which are in buy mode. You can do that. So now you're looking at those which are weekly buy and daily new buy, which means the weekly trend is up, but on the daily chart you're getting a fresh signal. And this is within the Nifty 500. And then within this you can actually choose which stock you like in terms of setup. You might want to do your own Elliott wave analysis, and you have all the options of doing that. But basically what the new buy means is that you're getting a new buy signal on the Rohit Momentum Indicator, or the RMI. Similarly, you get a new sell signal, so you may choose that, and then you get a buy and a sell. So a buy and a sell means that a buy or sell is already in force. Okay, so if it's buy, it means it's not a new buy. It just means that, well, the indicator's been in buy mode and it's still in buy mode. There's no trend reversal yet. Okay, and the same could be true for anything. I can choose CAT, find out that, well, this stock appears to be in buy mode, was in buy mode, and continues in buy mode on the weekly chart. Similarly, if I wanted stocks that were giving me short side signals at this point of time, I would unselect. Maybe I would look for new sell signals. And on the weekly, would I really want buy? So you can choose your combinations. For some reason, sometimes you might want a different combination, not necessarily a sell and a new sell. Sometimes you might want those which are in buy but are giving a sell on the daily. Why would you be looking for something? Well, whatever that reason is, it doesn't matter. But if you're looking for something, you can do a combination. Okay, and you can do a combination across these 3 time frames, and that's the idea, that you'll be able to quickly find and apply the RMI across stocks, across time frames, and the multi-time frame analysis will actually help you drill down on the stocks that you should be looking at. You can make the list really narrow, like I said, going with a smaller basket, and within that you only get 2 or 3 signals, and this is the focus of the day, and based on either the last closing or those which are possibly live trades. So you may get signals which are most probably likely to get generated today, and you might want to consider executing before the market closes rather than waiting for the next morning's opening. So these are all strategies that you can consider once you start looking at this in the way that I'm talking about. So I've taken you through all the advantages and uses of RMI, exactly how we go about it. The slides quickly put those points right in your head. So the trends with the market is what you get to know. Like I mentioned, the buy sell signals are faster, at least 2-3 days before the MACD will signal it to you. You'll probably get a signal on this indicator itself. Different setups available for the long side and short side. We will introduce a variation of the RMI that is upside down for short sales, but the very basic version that we have put here is pretty much good on both the buy and sell signals. The variation only sometimes gives you the move a day earlier, so it's more it's faster or more visual at times, and so we look at that. The smoothed indicator with few whipsaws and fall signals, that's what you will find, and works across time frames and across securities. I apply it to anything, not just equity, commodity, currency, so on. The RMI plots like any other momentum indicator on the screen, so that's what we've done. We've plotted it in the charting tool itself, and it comes along with a 9 EMA. The crossovers with the 9 EMA generate buy and sell signals. Okay, the zero line is important midpoint because we don't consider a cycle complete till you reach the zero line. As mentioned here, relevant buy signals are those which occur after the RMI has first fallen below the zero line, right? So first it must fall below, then it must cross above the red line and give you a buy signal. Similarly, relevant sell signals are the exact opposite, where prices move above the zero line and then give you a sell signal. Prices complete a bullish trend back and forth after RMI completes a full cycle and goes back to zero. Prices complete a bearish trend after the RMI completes a full cycle and goes back to zero. So that's broadly an explanation of how the tool plots. Okay, you do get price and momentum divergence. So let us look at that, because at times what will end up happening is that, like any momentum indicator, when you're looking at the RMI, you will find that, well, prices are going higher, but the indicator is not doing so. Okay, so let's look at a classic case. And it may work at some points of time. Like I said, that doesn't change the idea that we need additional confirmation. But what we do see is, like, prices peaked here, paused for a while, the RMI went into sell, but as the market made a higher high, you got a lower reading in the RMI itself. Now, of course, this amounts to a negative divergence in the indicator compared to price. Negative divergences can be an early warning of a trend reversal, and once you get a divergence, yes, we can think that, well, maybe the pattern is about to change. You can look for divergences on daily, weekly, monthly, but divergences are not a rule. They are essentially an observation that happens sometimes. Mostly when you think that the fifth wave is over, you will get divergences. Like we did think over here that this is 1, 2, 3, 4 and 5. It was possible that the divergence here, which is occurring in momentum, okay, is over, and we could have seen a slightly deeper correction or pullback, at least till the 40-day, 50-day average or something, if not more. But it didn't happen, so not all divergences will result in a reversal. but they do provide you with that early warning sign of a possible trend change. A buy and sell signal is the first sign of a possible trend change, which is why we use it to filter out where such trend changes may be signaled. Additional analysis is usually recommended. You could be looking for price divergences, which are an additional sign that maybe a trend reversal could be setting up in force. And further confirmation can actually come from the use of additional technical tools like trend lines or moving averages, along with the indicator, which would actually give you a better setup. The RMI itself doesn't give you price targets, and therefore risk and reward need to be understood with the use of tools like Elliott wave analysis. A two-factor confirmation will work better than a single factor. Advanced steps to execution involve combining different time frames as well, which means you do use the daily with the weekly or the monthly, and different time frames, when you put them together, give you much better results. At least 2 time frames are a minimum. If you're a long-term investor, you might want to look at multiple time frames, understand the bigger trend as well, but at least 2 is recommended. So if you're even doing momentum, which lasts for a couple of days, usually you would be doing a daily and hourly. If you're a positional trader, you'd be doing a daily and a weekly, and that would last for several weeks, and that combination allows you to time the larger trend better with the use of a lower time frame. Okay, so that's fairly the combination that we recommend. The lower time frame executes trades, just like I said. In a bullish trend, you will go long on a buy signal on an hourly chart and then exit. So basically what this is trying to say is what I mentioned earlier, that if the larger trend is up and on the lower time frame you're executing buy, exit, buy, exit, buy, exit. So if the larger trend is up, you really don't want to short, because going against the trend never pays off big. It causes unexpected or unnecessary losses. Similarly, if the larger trend is down and it's a bearish market, you want to do more of a short exit strategy rather than going short and long. Though in bear markets, you do get sharp bear market rallies where long side trades can be tried out, but requires an additional analysis and expertise. And the RMI signals, as I showed you in an up down market, does tend to give much faster, and the RMI indicator in an up down market does actually give you those fast and clean signals, as we saw in 2021 on the chart, where it didn't whipsaw and captures most of the trend, because markets are usually volatile in a bear market, and therefore the signals get cleaned up and they capture the entire move. So you can be on both sides, but if you're trading very short term and you're trading only one side of the trade, okay, and it's a trending move, so for example, if the market is falling, the daily, especially true when you're doing daily and hourly, so the daily trend is down, 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 then on the hourly you shouldn't really be doing counter trend trades on the way up. It's only at the positional degree that long short both make sense, otherwise they don't. Whichever the side of the larger trend is, if it's very, very sharp, you want to actually be on the right side of the overall trend, and definitely not miss out the right side of the overall trend. So that's those are thoughts that you need to bring in as you become an advanced trader using the RMI. Okay, the scanner itself upfront gives you the signals that are showing up, gives you multi time frame access, and allows you to filter down which signal you want to look at in which time frame. So use the filters and you get a perfect setup, and you can actually drill down to those few stocks, 3, 4, 5, 10 within the basket that you choose, where you really need to do additional analysis, and allows you to take quicker action if required at those points. So that's a very, very fast way to speed up your work and get to the next trade idea. So that's it for you guys. I hope that sort of clarified how you need to look at buy and sell signals and how to quickly generate them and find ideas. If you want to look at how the signal is happening on a particular stock, you come to the technical chart section, which is on your screen, and you can see the individual stock chart with the levels of the averages and the bands being shown you on the left hand side, since levels are important in the form of support and resistance. So you get a quick idea of the levels right here. But if you want to do scanning, you want to find the next idea to really trade, then you go to the scanner, search for those ideas, and then drill it down from there. So these are the two things to do. The RMI itself should be remembered as a sine wave cycle indicator, which captures momentum cycles that move above and below the zero line and allow you to capture a significant portion of the trend and not miss out on a particular move, using a couple of trend following tools. Like I said, trend lines, moving averages, RMI, a fair combination allows you to capture a significant part of the move in a particular direction. So that's all for you, and get down to using it right away. Thank you.